Japan just did the unthinkable. Again. But this time the consequences were seismic. A massive calculated sell-off of U.S. Treasury bonds by one of America's closest allies didn't just make headlines, it sent shockwaves through global markets, erasing $1.7 trillion in U.S. market value almost overnight. What followed was chaos. Public denial from Trump, private panic in Washington, and a scramble behind the scenes that could mark a turning point in America's financial dominance. Why would Japan, a country that's quietly propped up the U.S. dollar for decades, suddenly flip the switch? And more chillingly, is this the moment the world finally stops trusting American money? Make no mistake, Japan isn't some rogue nation playing geopolitical games. This is the world's fourth largest economy. For years, Tokyo's been a dependable backer of U.S. debt, consistently buying treasuries like clockwork. But in January 2025, that pattern shattered. Japan slashed its holdings by a staggering $119.3 billion, the steepest quarterly drop in over a decade. The data, buried in Treasury International Capital reports, confirmed it. The former top U.S. creditor had just handed that title back to China. The official line from the Bank of Japan? Domestic yield curve adjustments. But behind the technocratic jargon, economists like HSBC's Frederick Newman saw the move for what it really was. A hedge against looming U.S. fiscal instability. A financial red flag. A warning. And this didn't come out of nowhere. Japanese officials had been quietly voicing concerns about trade tensions, about dollar volatility, about a Washington that seemed increasingly unpredictable. Bloomberg reports now reveal that Tokyo is actively building out alternative regional systems, settlement networks denominated in yen, particularly with ASEAN nations. The message? Japan isn't betting on America forever. The tipping point? November 2024. That's when the U.S. Commerce Department blindsided Tokyo by slapping a 25% tariff on Japanese electric vehicles, citing so-called national security threats. Japan's Ministry of Economy called the move economically unjustified. Nissan's CEO warned it was a direct attack on innovation. The real reason? Fear, because Japan had just pulled ahead. Toyota's breakthrough solid-state battery tech, 750 miles of range, 10-minute charge time, was about to disrupt the entire EV landscape. U.S. automakers, still clinging to lithium-ion systems and choking on Chinese graphite supply bottlenecks, couldn't keep up. The tariffs weren't just about trade. They were a geopolitical defense mechanism. And Japan's response didn't come in the form of factory shutdowns or export bans. It came where it hurts most, the U.S. bond market. By Q1 2025, Japan held over 48% of the world's solid-state battery patents. Toyota and Panasonic were launching a next-gen EV platform with European pre-orders rolling in before the vehicles even hit the assembly line. Meanwhile, Ford and GM were slipping behind, and Japan knew it. For the first time in decades, Tokyo had real leverage, and it was ready to use it. Negotiators are now demanding U.S. tariff exemptions in exchange for access to their technology. It's a bold new playbook, trade access for energy dominance. Superiority in EVs isn't just an economic edge anymore, it's political capital. And Washington? It may soon face a painful choice. Double down on isolationist policies, or surrender the future of mobility. But the consequences of Japan's treasury dump didn't stop at symbolism. In February 2025, 10-year Treasury yields spiked to 4.89%, the highest since 2007, as foreign demand for U.S. debt evaporated. The Congressional Budget Office warned the surge could add $270 billion per year to debt servicing costs by 2027. PIMCO's chief economist Tiffany Wilding didn't mince words. Losing stable buyers like Japan erodes trust in treasuries and destabilizes global confidence in America's fiscal path. The dollar began to wobble. The dollar index fell 2.1% in 2 weeks. Central banks from South Korea to the UAE started trimming their dollar reserves. Higher interest rates, costlier credit, spooked investors, and mounting skepticism. The cracks weren't just forming. They were spreading. And here's the part that should keep policymakers awake at night. This wasn't an isolated tantrum. Since 2022, the dollar's share of global reserves has quietly slipped from 59% to 54%. Malaysia, Brazil, Saudi Arabia, they've all been quietly shifting toward yuan and gold. China's digital yuan now accounts for 5% of Southeast Asia's cross-border settlements. India's rupee is being used in oil contracts with Russia and Iran. What we're seeing isn't just a diversification of currency. It's the unmaking of a system. Zoltan Pozsar put it bluntly. The architecture of the global financial order is fracturing. Japan's exit wasn't a crack. It was a break. Between February 3rd and 6th, the U.S. stock market hemorrhaged $1.7 trillion in market capitalization. The S&P 500 cratered 5.4% in just 3 trading sessions. The question now isn't whether a new global financial system is emerging. It's how fast the old one is unraveling. And whether the United States, once the axis of global finance, can still command the world's trust, or if we're already watching the curtain fall. Markets don't crash for just one reason. They crack, splinter, and collapse under the weight of converging crises. According to Bloomberg, what triggered the latest meltdown was a volatile cocktail. Japan dumping U.S. treasuries, bond yields spiking to multi-year highs, and trade tensions that are no longer just simmering, they're boiling. The spark? The Trump administration's announcement of a fresh round of retaliatory tariffs, this time targeting Japanese electronics and South Korean semiconductors, setting off alarms over a potential trade war engulfing all of Asia. Investor confidence, already strained, snapped. BlackRock analysts pointed to policy unpredictability as the single greatest source of market risk. Moody's followed with a downgrade of the U.S. outlook to negative watch, citing swelling deficits and deepening geopolitical fault lines. Whether Donald Trump personally triggered the crash is still debated. What isn't in question is the market's judgment. This isn't background noise anymore, it's systemic risk. Trump once called 2019 the greatest economy in the history of America. But by 2025, many of the foundations laid during his first term are being reinterpreted, not as long-term resilience, but as short-term sugar highs that masked structural rot. GDP hit 2.9% in 2018, buoyed by aggressive corporate tax cuts. But those same cuts blew the federal deficit past $984 billion by 2019. By fiscal 2024, it had surged to a staggering $1.9 trillion, according to the Congressional Budget Office. Brookings economists argue that the administration's deregulation binge and escalating trade battles weakened America's grip on global supply chains while injecting inflationary pressure. Former Fed economist Claudia Sahm summed it up to Bloomberg with chilling clarity. Stimulus with no structural reform created sugar highs, not stamina. The recovery was brittle, a mirage of strength that crumbled as international trust in U.S. fiscal discipline eroded. While Washington continued its fixation on decoupling from China, others adapted. Quietly, Canada began hedging, accelerating trade integration with Europe and the Indo-Pacific. In Q1 2025, it inked a digital currency interoperability pact with the European Central Bank and Australia's Reserve Bank, aiming to bypass SWIFT and reduce dependency on the U.S. Meanwhile, it locked in long-term critical mineral deals with the EU and Australia to sidestep potential U.S. export controls. Trade with the EU surged 16% year-over-year. Exports to the U.S. down 3.4%. As Canadian Finance Minister Chrystia Freeland told the Globe and Mail, economic resilience today means not being overly dependent on any single economy, even an ally. Then, in January 2025, Trump lobbed a 200% tariff on European wines in response to EU data privacy fines against U.S. tech giants. It wasn't policy, it was provocation. France, Italy, and Spain hit back through the WTO and targeted U.S. pharma, medical devices, and aerospace components. Within a month, the U.S.-EU goods trade surplus shrank by $13.6 billion. Airbus's CEO warned of a potential seizure in aerospace supply chains. Meanwhile, California wine exports to Europe plunged 22% in one quarter. What started as a symbolic jab had morphed into a high-stakes game of economic chicken with America's closest democratic allies. J.P. Morgan analysts didn't mince words. This was the edge of a full-scale trade war. It got darker. In February, a D.C. Circuit Court blocked the White House's latest tariffs on South Korean chips, citing flimsy national security claims. Trump ignored the ruling. The administration invoked Section 232 of the Trade Expansion Act, a Cold War-era provision meant for real emergencies. Legal experts sounded alarms. Yale law professor Bruce Arian called it a direct constitutional confrontation. Markets took note. Treasury yields spiked 29 basis points in 24 hours. Foreign investors yanked $21.7 billion from U.S. equity ETFs. The signal was loud. The rule of law in Washington is no longer a given. It's a variable. And then came something almost unheard of. On March 2, 2025, Chief Justice John Roberts broke protocol and issued a public rebuke, warning against executive overreach in economic matters. Courts, he said, were being systematically sidelined. His remarks came as foreign governments flooded U.S. courts with amicus briefs, alarmed by vanishing legal predictability in American trade policy. The World Bank's latest governance report reflected the fallout. The U.S. dropped 5 spots in judicial independence, now trailing Canada, Germany, even Singapore. Markets reeled. Credit Suisse reported overnight volatility spikes and 5-year credit default swap spreads widened by 14 basis points. Roberts wasn't making a partisan appeal. He was firing a flare into the sky. U.S. credibility no longer rests solely on its economy. It now hinges on whether its laws still apply to those in power. Meanwhile, the dollar's grip is loosening. It still accounts for 54% of global reserves, but that's down from nearly 62% in 2020, and the trend is accelerating. According to the IMF, 13 central banks, including Brazil, Egypt, and Indonesia, are now settling bilateral trade in local currencies or digital alternatives. China's cross-border interbank payment system processed $447 billion in non-dollar transactions last quarter, a 34% increase year over year. The BRICS Pay initiative, backed by Russia, India, and South Africa, is set to go live in July, offering a non-SWIFT global payment system. At the Council on Foreign Relations, former Fed Chair Janet Yellen didn't sugarcoat the implications. "We are entering a more fractured monetary era," she said. "Dollar dominance won't end overnight, but it's no longer unquestioned. And if financial systems start bypassing the dollar, the U.S. loses more than transaction fees. It loses leverage. And what fills that vacuum? A world where rules are written in real time, in fragmented spheres of influence, not from the White House, but from every corner of a multipolar planet."